What's up, guys? Victor here. So late last week, the market caught a bit and continued that trend through first day this week. What's going on? Let's unpack a couple of things. Firstly, stocks tend to perform well in early weeks of earnings releases. Secondly, we saw quite a bit of short covering. Thirdly, we saw easing in US dollar pressures. And lastly, we saw smart money buying. Big picture, is this a bear market rally or is this a turning point? Again, a couple of things to unpack. From historical perspective, this would be a relatively normal bear market rally. Most of it was driven by expansion in valuations, and in my view, there is not much of an upside until the Fed pivots. Second aspect to consider is US dollar. Strong dollar is detrimental to US companies' corporate profits, plus it increases the risk of emerging market debt defaults and hence global financial contagion. And again, I don't think there's much of an upside until the Fed pivots. All in all depends on the Fed and when they will pivot. Currently, the market is pricing that they will pivot by year end. If you think it will be faster, you might want to see this as a turning point. You might want to start buying. If you think that they will pivot later, probably you should be waiting. Weekly performance showing the strong trend. Since first day last week, we were increasing at a nice clip, gaining 7.8%. This is S&P 500. I want to show you a couple of levels on S&P 500 longer term price action. So we saw high at 4,800, then we saw a lower high at 4,600, then again lower high at 4,200, now lower high at 4,000. 4,000 is a strong resistance level. If the markets manage to break through, and next resistance level is at 4,200. Let's look at performance of sectors. Consumer discretionary materials, industrials, energy, all of these sectors up. Healthcare, utilities, the two sectors that are down. Style factors, small caps up, momentum down, yields down across the board. Let's dig deeper into the key data. So I'm gonna, you can stop the video here and dig deeper into the slide, but really the key message is bear market rallies on average last 15 days and are 8.4% in size. Another slide on short covering. So we saw high short interest stocks surging off their June lows. Slide on valuations. Here I'm borrowing from Alf from the Macro Compass, great Substack. You might want to consider following him. So this chart shows that the valuation levels here represented by S&P 500 12 months forward earnings yield, the blue line, really follow very closely the real yields, the 30-year real yields. You might want to pause the video and think about where you think the real yields will go from now forwards. Here, initial results of the earnings season. In Q2, we saw 73% of companies beating their earnings expectations. Compare that to an average of 80%. And we saw 57% of companies beating their revenue expectations, compared that to 70%. Want to dive deeper on US dollar in this episode. So again, borrowing from Alf from the Macro Compass, on the left, you can see that 22% of US corporate profits are generated abroad. And then on the right, you can see the dollar index, really strong uptrend. Now we are kind of in the middle of that uptrend, last week dipping below it. You might want to pause the video and think about where you think US dollar will go from now forwards. Let's discuss Tesla. Tesla released earnings this week. Of course, everybody probably heard about them selling their Bitcoin holdings, but here I want to discuss two things. One is price action, a really nice example of a wedge and a strong breakout in upon earnings. And secondly, I want to discuss their deliveries. So in Q2, Tesla delivered 255,000 cars, roughly half of that produced in the Fremont factory, large part in the Shanghai factory, Berlin factory starting to ramp up 7,000 cars in Q2 compared to 200 cars in Q1, and Texas also starting to ramp up almost 2,000 cars in Q2 compared to 0 cars in Q1. Overall, we saw drop in deliveries in Q2, mainly driven by the lockdowns in Shanghai in China in Q2. If you look at the whole 2022, Tesla is on its track to produce 1.4 million cars in 2022, and they are on the track to finish the year at a run rate of 2 million cars annual installed capacity. In this week's episode, I want to discuss quickly Treasuries, a very important investment instrument in this period. In the two charts on the left, I really show the demand side. Probably the largest buyer of US Treasuries is the Fed, and as we know, the Fed is letting its balance sheet run off. They are not replacing treasuries that are maturing, so this buyer is out. Second buyer that is partly out is China. So those are kind of negative drivers for treasuries. The positive driver is that the federal budget deficit is really going down significantly. No more stimulus checks, more revenue for the treasury from inflation, relatively good economic performance in 2021. So the Treasury will not need to issue as many treasuries to cover their budget deficit. For what's it worth, this slide shows the demand-supply dynamics of treasuries, and I think this really shows a healthy, sustainable future for treasuries. Some interesting news. So the ECB, for the first time in like 10 years, hiked their rates, this time by 50 basis points, strong move. The euro reacted strongly up, but quickly reversed the price action when the ECB President Christine Lagarde gave her press speech. From the crypto land, interesting news, the Tether regained its peg. Well, this was a huge systemic risk. I mean, it is still a huge systemic risk, but now that it has regained the peg, probably not as acute as it was. Let's turn to next week. This will be a super important week. We will have the federal funds rates, we will have advanced GDP, consumer sentiment, manufacturing index in the US and in China. And this week, I believe more than 50% of companies in S&P 500 will be releasing their earnings. So really, stay safe this week, guys. Thank you for your attention. See you next week.